You're with us on BtTv. Well, markets are bleeding, and how this afternoon it's a whole host of worries. Just when we thought, we were closing the year on a high, Indian markets had shown tremendous resilience. What we have today and what we've seen this week is a lot of nervousness on the back of first that surprise move by Japan, increasing inflation and rate worries, and now, of course, COVID making a comeback. Let me welcome in Kranti Batini, who's also joining us. Kranti, great to have you with us. And while I just pull up some of those losers on the screen, the Nifty down over 200 points now. It's cracked 18,000. How worried are you about what we're kind of seeing here and the turn for the worse that we've taken?
If you see last 1 year Nifty performance, in the same way Nifty tried to, it came below 18,000 levels and it attempted to stay above 18,000 levels. What we are seeing is last 1 year, whenever Nifty tries and uh, trying to go above the 18,000 levels, market is witnessing some kind of tiredness, and it looks this time everyone expecting a Santa Claus rally, and market is going to hit 19,000 levels. That was the mood of the market nearly a fortnight back. But today, market again came down the sixth time below 18,000 levels. So it is coupled with, as you mentioned, the global recession worries one hand, and the other hand, the COVID fear, and also rising interest rates and tightening liquidity. These are the factors that creating pressure on the markets. What we can witness is there is a kind of panic selling by retail investors, because retail investors have been very active in the market in past 18 months. So some kind of panic selling is striking the market right now. But Indian markets, time and again, in the past 1 year, if you see the market performance, time and again, it's shown as Indian markets are resilient and resurgent markets. Uh, this time, the worry is the COVID fear is mongering the market right now. But this time also, market should show the resilience as we are going to enter into the new year.
Okay, let me just go across to Chetan because he's been standing by. The Swan Energy-led Hazel Mercantile Consortium plan for Reliance Naval Defence and Engineering has been approved today by the Ahmedabad Special Bench of the NCLT. They've meanwhile rejected Jindal Steel and Power and also Reliance Infrastructure appeals. Chetan, go ahead, tell us more about this story.
Well, absolutely, Abba. It's a fresh breaking development and breaking news on Business Today. The Nikhil Merchant-led Hazel Mercantile Consortium plan has been approved by the NCLT. However, the winning consortium was given the letter of intent in March, but the formal approval by NCLT came in today. The Hazel Mercantile approval plan was, in fact, approved by the lenders with an overwhelming 95% majority. Also, the appeals filed by other bidders, including JSPL and Reliance Infrastructure, has been rejected by NCLT. In fact, it's important to note that Reliance Naval owes its creditors a whopping about 12,429 crore rupees, with SBI and Union Bank of India being the main lenders. So clearly, in times to come, we can expect some relief for the lenders. But yes, a majority haircut would have to be undertaken by the lenders as well.
Thanks for bringing us that.
Okay, it looks like it's a preparation for COVID kind of a situation. That is the mood in the market right now.
Okay, right, fair enough. Okay, let's put COVID aside for a moment. And if there were some favorites on your list until 1 week ago, what would they be? And I'm assuming they're still your favorites, or it's just that we're in wait and watch mode for a few weeks.
The financials remains our favorites, like the large cap private sector banks can be our favorite and remains our favorites. Any dip, the panic in this market, and the sharp selling that is exaggerating in this market can give us a good opportunity for the investors, and also for the investors who have a very long-term horizon. Definitely, they can consider IT, which is lost its flavor right now. But the large cap ITs like Infosys and TCS, one can keep on their watch list, and they can accumulate in their portfolios. And we also can't ignore auto pack also. Of course, autos have been outperformance in past few months, but any dip, definitely investors can keep on their watch list and accumulate for medium to long term.
Amazing. Thanks so much for joining us today, Kranti. Always a pleasure. Have a good weekend. And Clear trend, and as Kranti also pointed out, of course, he also named a few interesting stocks to watch out for. But financials, large caps, in fact, most of the experts that we've spoken to this week have clearly deferred to the large caps for now. A little bit of uncertainty in the market, but most of our experts saying just wait and watch for a few weeks. This should blow over. Overall, not too concerned. Metals seem to be an avoid for the moment. But other baskets, whether it be IT, auto, select names, and select heavyweights, continue to be on the pecking order for many of these experts. But what is clearly sweeping the game away is financials, private sector, and then depending on who we speak to, some of those PSU names as well. Pharma clearly making a bit of a comeback with all those COVID concerns. So a clear trend emerging across the board. But otherwise, quite a day for the markets so far. Bleeding really across the board. Metals taking the biggest knock on what we're seeing in China, and a whole host of other segments as well across the board, really seeing quite a bit of a battering in the markets, cracking 18,000 so far. Sensex down 700 points. 60,000 is where we're looking at on the Sensex. It's not looking pretty this afternoon. Let's see if we manage to claw back some ground before closing, but otherwise it's definitely looking like quite a battering for trade so far.